So that's why when I look at the broader markets right now, when I look at kind of the markets, my expectation is that you might get some weakness here over the next few weeks, uh, but that weakness largely will likely be contained to that 5,100 downside on the S&P 500. Now, if we break 5,100 on the S&P 500, first of all, my guess is that it would take a bigger catalyst to actually make that happen. Right now, the biggest risk probably is with the Fed. The markets are pricing in a 50 basis point cut in September. If, let's say, the Fed chooses not to cut 50 basis points, maybe they only cut 25 basis points, that is a potential catalyst, where the markets are expecting something and the Fed doesn't deliver on that. That is a potential catalyst for markets to move lower. Other than that, you really just have to see, the U.S. employment picture, the labor picture deteriorate fairly substantially, in my opinion, in order to kind of create that catalyst to drive things lower. Because corporate earnings are strong. We had a mixed season, but that's because earnings expectations, I would say, going into the season were too high. Analysts have already cut expectations for next quarter at a faster than average rate, which means that we have a higher probability that more companies will beat on earnings next quarter. The outlook going out 3 months into the next earnings cycle at the moment still looks quite positive. So overall, you don't have the the makings, if you will, of a bear market just yet. Certainly some volatility, but not the bear markets. So we do have to factor that into when we think about kind of expectations. And this is the probability of rate cuts. So we're currently at 525 to 550. So in September, right now, the highest probability the bond markets are pricing is down to 475 to 500, which is an equivalent of 50 basis points, 55% probability of that happening right now. In November, we're looking at a 52% probability of another 25 basis point cut. And then in December, a 47% chance of another 25 basis point cut. So that equates to 100 basis points in cuts between now and the rest of the year, which also is supportive of equity markets if interest rates were to decline by about 100 basis points between now and the end of the year. So, with all of these things in mind, like I said, it doesn't provide the backdrop of substantially lower markets. Okay. So hopefully I wanted to try to get that out of the way. A lot of investors have been asking, should I be selling into rallies? Should I be concerned about a lot more downside? Should I be getting out of my stocks? Should I be moving into cash at this moment? Based on where we stand right now, it doesn't quite look that way. Can things deteriorate? Sure. But that's why we're here every single week, every single Monday to keep you abreast of these macro conditions, these macro indicators, to give you a better understanding of where we currently stand. Monday was by all means a very ugly day, a very violent day that probably many of you have seen losses in your portfolio as a result of it. But I will say it's how you react to it that will determine, how successful you are as a trader. And this week, multiple opportunities to get into the markets. And I think we need to take some of those opportunities to get into the markets right now. Okay, so let's take a look at bear market stats. And we're going to talk about this just so that you have some information about it, not necessarily because we believe that there's a bear market coming, but remember that bear markets decline of over 20% from, like how we define a bear market is if the market declines more than 20% from its peak. Typically, you have higher market volatility. In this particular instance, we're not 20% down from the peak. The NASDAQ 100 on Monday did open up technically in bear market territory and very quickly recovered from that by Tuesday. So while we're not in a bear market now, the NASDAQ 100 could turn into a bear market if it does break below the Monday low. So that is one thing to keep in mind. It's more of a technical term, more so than anything else, simply when it's more than 20% from its peak. But the one thing to statistically remember is that markets trade higher 60% of the time and lower 40% of the time. So statistically speaking, you have an advantage to being long the market than being short the market. And if you're going to be short the market, you better be more nimble with those shorts than you are with your longs because markets don't stay bearish as long as they do stay bullish. And that's an important thing to remember. But probably the more important thing here is not just in terms of time, but markets tend to sell off faster than they climb on rallies. As they say, markets take the elevator down and the escalator back up, meaning they fall very, very fast at the downside and then take a much slower grind to get back to where they are. So, those are some of the things that you have to factor into, the timing of the markets and also what type of option strategies make sense given the type of the type of outlook that you might have on a given security. So with that, let's talk a little bit about kind of bear market trading. If you are to trade a bear market, meaning if you are trying to push shorts in the market, remember that risk to reward favors waiting for rallies. So let's say a stock is bearish, waiting for rallies before you enter a bearish position. And this is all about skewing risk to reward in your favor. Because if you wait until a rally to sell, the goal of waiting for a rally is that you want to basically target a fairly sizable downside target and at the same time have a relatively small amount of risk on the overall trade. And this is a chart of Royal Caribbean. This is an old chart, but it doesn't really matter because it's for illustration purposes. The idea is that wherever you enter, you want to understand where is their prior support, because that could be your potential target to the downside. And then you want to understand what was the recent highs, right? So for example, if the recent highs on here was around 52.5, you generally want to understand that if it breaks out above 52.5, then your bearish thesis is likely not working out. You want to cut your losses. And what you want is how far does the stock need to move before you would say, I'm wrong and I need to cut my losses? And how big is that in relation to how far the stock needs to go in order to hit your take profit? So what you can do here is using rallies to kind of find opportunities where the risk to reward is skewed as best in your favor, because bear markets are not easy to trade. Statistically, it's skewed against you. You tend to get these moves that are fast and violent, which means that you don't have necessarily a lot of time to get into these trades and get out of these trades. So they're very time sensitive. So in order to do so, you want to do so in a way where your risk reward is skewed as heavily in your favor as possible. Technical indicators can be utilized to determine when overbought rallies, when rallies are overbought, and you can sell into them. That's for if you're trying to follow the bearish trend or follow the bearish market. However, another thing that you have to also consider is that as markets fall, the further it falls, the more attractive they become for buyers, right? If the markets fall, that means stocks are trading at lower valuations. They are, we've all heard the old term buy low, sell high. Well, how do you buy low? You wait for markets to sell off. You wait for bear markets. That's when you buy low. So when you do get into a bear market, you got a lot of investors that are now looking at that as a buying opportunity. So that is also, a trading strategy for bear markets that I think a lot of traders kind of overlook. When things get ugly, we're all thinking about shorting the markets and how much further markets can go. But by being a bit contrarian and, as markets get really volatile and as they get scary, thinking about being a buyer is actually the right framework to go about thinking about this.